Imagine stumbling upon a weather-beaten chest buried in the sand while strolling along a secluded beach, or uncovering a forgotten bank account in your name that has been accruing interest for decades. The sudden thrill of discovering unexpected wealth, be it a relic from a bygone era or a more mundane windfall, is the stuff of dreams and blockbuster plots alike. But after the initial excitement fades, a more practical question emerges. Do you have to pay taxes on found money? Navigating the tax implications of unexpected gains can be as intricate and layered as the plot of a mystery novel. Whether it's money unearthed in a backyard, an unexpected inheritance, or even a substantial find in an old piece of furniture, understanding the tax requirements is crucial to fully realizing and legitimizing your newfound wealth. The Internal Revenue Service, IRS, in the United States, along with similar authorities worldwide, have clear guidelines on such scenarios. Let's delve into this landscape to uncover the obligations that come with unexpected financial gains. First, it's essential to establish what constitutes found money. For tax purposes, found money can include any unexpected lump sum, discovered cash, property, or even significant finds, like art and antiques. These are often considered as windfalls under the umbrella of gross income. According to the IRS, if you find and keep something of value that did not belong to you, it counts as taxable income. This is categorized under Other Income on Form 1040, the standard federal income tax form in the US now. Let's explore a few scenarios to illustrate how these rules apply in everyday life. Imagine you find a rare coin in your grandfather's attic. Once the coin is sold at auction, the influx of cash is not merely an addition to your bank account. It also becomes a part of your tax obligations. The same goes for any item you might find and then sell, including items bought at garage sales or antique shops that turn out to be worth more than you paid. This increment in value is subject to what's known as capital gains tax, which applies if you sell the item for more than its original purchase price. Moreover, suppose you accidentally discover a hidden stash of cash within the walls of a home you recently purchased. In the eyes of tax authorities, this found money is taxable as ordinary income. This kind of scenario isn't just theoretical. There have been real cases where new homeowners have found caches of cash left behind by previous owners. The IRS expects individuals in such situations to report these findings as income during the tax year the money was found. Moving beyond tangible cash, let's consider a more modern form of found money: forgotten or unknown financial accounts. It's not uncommon for people to discover that they were named in a relative's will for an asset they hadn't previously known about, or to find dormant accounts in their name. These accounts often accumulate interest, which can significantly increase their value over time. Upon claiming these funds, not only the principal amount, but also the interest earned is subject to income tax. However, there are nuances and exceptions in tax policy that could affect the amount of tax you owe on found money. For instance, if you find property that appreciates in value after you found it, but before you sell it, you may only owe capital gains tax on the appreciation. In this case, understanding the specifics of capital gains tax, including how long you must hold on to an asset before selling it, can influence your tax strategy. Gifts and inheritances, though often considered found money, typically do not incur taxes for the recipient under current U.S. law, but might still require filing specific forms if they exceed certain thresholds. These thresholds vary, so consulting with a tax professional is advisable to navigate these waters successfully. In conclusion, while the dream of finding a treasure chest or a forgotten bank account may seem like an unequivocal boon, it is important to remember the accompanying tax responsibilities. The intricate dance between unexpected gains and tax obligations requires a careful understanding of tax laws to ensure that you remain compliant while maximizing the benefits of your newfound wealth. Whether you're an accidental treasure hunter or the beneficiary of an unexpected inheritance, being informed and prepared is your best strategy. Paying taxes on found money not only keeps you within the law, but also helps pave the way for these unexpected blessings to truly enhance your financial landscape, free from future complications. Thus, next time you dream about finding hidden treasures Also think about the less glamorous but equally important task of planning for its tax implications. Imagine stumbling upon a weather-beaten chest buried in the sand while strolling along a secluded beach, or uncovering a forgotten bank account in your name that has been accruing interest for decades. The sudden thrill of discovering unexpected wealth, be it a relic from a bygone era or a more mundane windfall, is the stuff of dreams and blockbuster plots alike. But after the initial excitement fades, a more practical question emerges. Do you have to pay taxes on found money?